Welcome everyone to today's panel. This is the art of valuation. In this specific panel, we're going to be talking with valuation specialists to talk about the startup valuation, how it differs from regular company valuation, valuation caps, convertible notes and safe notes, how international companies are valuing their companies, and is it good or bad, and also tips for avoiding any type of specific pitfalls when evaluating your own startup. We have three people joining us today. The first one is Adrian Fortino. He's a managing director at Mercury Fund, an early stage venture capital firm based in Texas. At Mercury, Adrian focuses on investment in enterprise SaaS, industry IoT and tech-enabled service companies. And Adrian has also experienced in the fundraising process from the other side, since he also co-founded 3 software companies. The second person today is Jeff Erickson. He's a director of business development at Carta, a company specialized in capitalization table management and valuation software. Jeff is a seasoned executive with over 20 years of senior level management experience. He's also an experienced entrepreneur, founder, and successful of consumer goods company. The third person, Rob Tompkins, is CFO for early stage startup companies and an active mentor at Techstars Austin. He was the former managing director of early stage client acquisition at Silicon Valley Bank. And before his tenure with the client acquisition team, Rob led the research, valuation, and advisory arm of Silicon Valley Bank. So first of all, thank you so much for joining us today. I think it's going to be probably one of the most important panels for every single founder out there from the accelerator, because we're going to be focusing in topics that every single one of them has issue with. That's valuation of their companies. So we want to hear from you, a specialist in the subject. You have been working with venture capital firms, angel investors. You understand what are VC funds taking into account for determining the valuation of the companies, not only right now, but also for the valuation cap when using convertible notes or safe notes. Specifically, I wanted to start this session talking about a startup valuation and how it differs from regular company valuation. In the first place, what are some common use methodologies for venture capitalists to evaluate their potential investments? How do they differ from regular valuation methodologies used in investment banks for evaluating public and private companies? Adrian, I don't know if you can kickstart this conversation. Sure. Since you are right now working in a venture capital firm specifically.
Mm-hmm. Thanks, Fernando. Yeah, so the quick context on our fund, we've been around for 15 years and have always been an early stage investor. So lots of pre-seed, pre-revenue investments in the sort of more distant past. And then over the past, 5 to 7 years, I've been more active in the seed and Series A, so sort of post-revenue, but have a good picture of that very early stage investing and kind of valuation. And what I told Fernando when we talked last week, that for us, it is most investors at our stage, it's more art than science. Right. No one in my world uses DCF, discounted cash flows. There is the EBITDA is negative, right? The cash flow is negative generally. So it just doesn't really work like that, right? So really the way it works is for most investors in my world is thinking about it from an ownership basis. And that could be anywhere from how people set caps on convertible notes or safes to pure equity deals where they get a certain percentage of ownership in the company for a certain dollar value. By and large, that's how people think. When I go in and I look at a company that's a seed stage company, I say, where are they? Where's their product? Kind of how much revenue do they have? And then how does that all sort of comport in my head to say, then I think I'm comfortable writing, this check, this, $1.5 million check to get, X number of percent for the company. And do I feel good about that? Does the post money look right for the company at the stage, from that perspective? And then do they have an uplift opportunity for that next round?
Definitely. And I see that there are a lot of software software options out there that basically allows you to create a valuation of your company based on very specific assumptions in terms of expected growth, the industry you are right now, when you use additional ratios of other companies that are similar to yours, to try to create this forecast of either cash flows or comparable companies, and try to get a valuation. What's the role of these softwares on the valuation process for venture capital firms, or is it a good idea to use it as a baseline for evaluating your own company as a founder, Adrian?
So, I don't personally see the value in software kind of driving that analysis. To me, it's very simple, right? You have a certain revenue, you have a certain growth rate, right? You can look at that and you say, what does my forward-looking kind of growth rate and revenue look like? And have a conversation around what does that justify or mean for for the ability to kind of generate the kind of valuation that I think is interesting to me as a founder, right? Mm-hmm. What I don't see necessarily is the need for, and this is just me and the way that we work, and certainly founders that we work with, I haven't seen the need for specialized software to do that work, right? In our world, I think the metrics that people will look at, though, at times they might look at sort of a multiple on ARR, right? Mm-hmm. They might, and then they might actually look at doing a premium on that based on growth rate. If you're 250, 300%, they might look at that. But even those sort of, conversations, those are fewer and further between, honestly. More often than not, it's like, hey, I'm willing to write, as I said, a $3 million check for 20% ownership. I think that's about right for where the company is. And I think, what do we think, right? So,
definitely.
Yeah.
Go ahead, Rob.
I would just add to that I think we used to say at SAB, it's just more important for founders to be creating value rather than measuring it, right? I mean, it was just and so the idea that if you're gonna try to get into this exercise, whether it's in Excel or Google Sheets or whatever, or in software, where you're trying to forecast with a lot of granularity, everything from growth rates to your financial forecasts, the full gamut, and how much additional capital it's going to require to be able to reach those forward-looking forecasts. It just becomes this kind of house of cards, right? So it's just kind of a waste of time, I think, in the very beginning. It's good to have a model, but the model really should be kind of thinking about the next 12 to 24 months, really, literally the crux of it, and be very, cash focused, right? How, what do I need to do to ensure that I've got on the right growth path, and that I'm not going to run into any cash flow?
Yeah, like Rob said, you're looking at the next 12 to 24 months, and at the early stages, you're probably not in a position where you're going to be measuring profitability in a lot of cases. So, I mean, the discounted cash flow method or whatever that you learned in your finance classes is just not applicable. Yeah. So what I have seen the use of software be valuable for on the company side is for modeling out things like your notes and the dilution that you might see from future investment rounds. And so I think it is important for the founders to realize when they're giving up a 20% discount, let's say, for a note, that is, at a discount of their next round. And they want to make sure that they're modeling that out of what's it going to look like if we go out and our Series A we raise at a, $15 million, pre-money valuation. What is that going to look like in terms of the dilution because of all of these notes that we've done at a 20% discount? That's where software comes in and becomes really valuable for you and for the investors to that point.
Sure does, Jeff. And it's a great point. And I was speaking just on the setting evaluation, but you're 100% right. Carta's fantastic for this. Man, I wish that more people would go and model out what it's going to do to their ownership if you take, this note on a 5 cap, the next note on a 7 cap, and the next note on a 10 cap, and do that stack up of all of those notes and how those caps really begin to degrade their ability to retain ownership. We see it way too often. We have these stacks of notes and you just, you're kicking the can down the road. And honestly, you'd be better off just pricing around, right? After a note, price it, and then move on, because you think you have this big equity position, and all of a sudden, when it comes to it, man, is it degraded really, really quickly with all those stack ups.
Yeah,
I'm sure you've seen that, Adrian, where founders are kind of shocked when you guys come in and do a Series A, and they're like, "Wait a second, we didn't know we gave up this much money to all these note holders."
Yeah.
Yep. As a follow-up question, Adrian, what do you do when you are facing with companies that are super early stage? They are probably pre-revenue or pre-product, and they are still like trying to figure out what are they selling, right? And they are already looking for investors, and maybe you see them as a potential investment because it's a great idea, or there is a market opportunity out there. What do you do in those cases?
Yeah, so we don't really do those investments now, but I can speak hypothetically, right? And certainly from the past, right? What we would do in a hypothetical case like that, what we would do is we would look at it exactly what we talked about earlier. We'd do a note, right? More than likely, and we'd say, okay, here's the amount of money that we're okay with kind of investing in a company at this stage, and here's the sort of dilution and or ownership that we think is right for this one. And that right is the art part of it. Like, is it 10% dilution? Is it 20% dilution? Right? Depending on how much money, whether it's 500K or $1 million, but it's all about like how much dilution do we think, and does the founder think is the right amount, or effectively not too much at such an early stage? Because this is all the guys, Jeff and Rob know this. You raise that pre-seed round, then you raise a seed round, then you got to raise a seed extension because it didn't quite get there. Then you do an A, and all of a sudden you're in single digit ownership after your A round because it wasn't, maybe, weren't quite as efficient as you wanted to be with cash, right? Or you have too many co-founders, right? And you've spread the equity too widely, and you didn't invest immediately when you should have, right? Yep. All these things that kind of come into this. And I mean, that's the thing that gets us, we're like, oh man, we call it a broken cap table. And both these guys know this well. Yeah, and Series A, you get a broken cap table, and what do you do with that? I mean, you can fix them, but it's tough.
Yes, exactly, and we see these on the accelerator on a common basis. And I wanted to ask you, Adrian, is there like a specific point in which, if the owner or co-founders don't have X amount of the ownership, you are just not interested?
Yeah, I can give you a pretty clean answer there, actually. So we're our latest investment is a Series A. Okay. If we're engaging in a company with a Series A, and the let's say that the top couple of key co-founders, let's say, mm-hmm. if those people that are going to drive the value of the company in the future, if they're in the single digits, it makes it really, really hard.
Okay.
Right? Impossible? No, because there's ways that you can deal with that, and doing top ups and bigger option pools and things like that. But man, as a general rule, you really don't want to see those top two, people. And again, as the more co-founders, the easier that happens, right? And so that's why, you really like to see co-founder, tandems of, preferably 2, so you're not spreading that early equity out too much.
Sounds good. And it's also, I guess, to keep them motivated to grow the company, right?
Well, certainly, yeah.
And I think the point there is that, Adrian mentioned the vesting and having the vesting schedules. I mean, as a founder, you're still going to be vesting your shares, over those, by the time you're at a Series A, you're probably still pretty early on in your vesting schedule, so you've got to be bought in. There's got to be enough equity, to get you through the Series B and C and D. And so you got to be really careful on what you're giving up early on and who you're letting on your cap table.
Yeah, and I think we've all got sort of, I'm sure, war stories about, cap tables, like you said, that were broken, where that actually end up dissuading, any future investment, because the investors said, we can't fix this without it being so disruptive and causing so much tension, like especially on the coast where you've got a lot of deal flow. You can just sort of say, okay, look, I'll just move on to the next deal, right? So making sure your cap table is intact and in good shape and correct, right? Jeff, it really is important. And then being able to, like you said, Adrian, making sure that you can roll it forward kind of in a simulation fashion and make sure that you're not going to have any downstream, at least near term issues. And that's priceless. Can make the difference to whether you raise a round or not.
Yep, definitely. Jeff and Rob, there is another big question that always appears on the accelerator, and no one is able to provide like a conclusive answer to that. And that's related to the 409A valuations. I know Carta is a software that gives you the tools to do this type of valuations. I know, Rob, you have experience with this specific type of valuations. Can you explain to all the founders out there what is a 409A valuation and how it differs from the enterprise valuation you're going to be using for raising funds, or eventually do the cap on your convertible note?
Yeah, absolutely. I mean, the short answer is they're completely different. I mean, there's the only reason you need a 409A valuation is for your stock options. As your it's setting a strike price for your stock options that you're giving out as part of your equity incentive plan. And you want that typically to be as low as possible. So it's just the opposite of your enterprise valuation, where you're going to want to have that fair or maximize a valuation on that. So they are completely different. Don't confuse your 409A valuation, which is a tax compliance valuation, with your enterprise valuation. It's more of a compliance step than anything else.
Yeah, and I think and without going down kind of a rabbit hole on 409A, I think it's important to get it done correctly. Kind of like doing your taxes, right? You want your taxes done correctly. You probably want someone else to do it for you, and and you want to make sure that that it's used for its specific intended purpose. I think some people say, well, then how do you value the company in a 409A? I think really what's interesting is that a 409A valuation anchors around and pivots around the valuation that's set by the investors. So if Adrian says, I'm going to invest and it's going to be $1 a share, and I'm going to invest in preferred stock in a first price round, then the whole 409A valuation anchors to that. Okay. So I would just sort of put the 409A valuation off to the side and really focus on creating value and being able to, and demonstrating value and getting your enterprise valuation, your valuation when you're actually fundraising, in the best spot it can be, right?
Terrific. So 409A valuations only when I have preferred stock or options, as in a early stage company.
Yeah, I mean, that's right. I'll defer to you on this. I back in when I used to do 409A, we would say don't do a 409A until you have a price round, right? Okay. But I've seen some folks do 409A when they have a really large round, a lot of convertible notes. Maybe they're getting into like above $1 million in convertible notes, and maybe there's been some material value creation. But I don't know, Jeff. What are you guys seeing now?
We're seeing, I mean, a lot of times, if you're rolling out a stock option plan and you have some value to the company, I would definitely talk to your attorney. Your attorney is probably going to be the one that will, encourage you to get a 409A, be in compliance. The price has come down on them so significantly. I mean, Carta just includes them now as part of the software plan. So, if you're going to be issuing stock options, there's a good chance you'll want to look at getting a 409A valuation if you have some value to the company.
Definitely. Thank you so much, Jeff. Moving on to the next topic that we want to go a little bit deeper is convertible notes and safe notes. You see the founders, they are having this headache trying to get the valuation of their company. And then we say to them, hey, get a convertible note, get a safe note. You don't have to worry at all about valuation. You just have to worry about the valuation cap in the future. But how does that work for the other side, for the venture capitalists and angel investors? How do they calculate that specific value in the future that is going to be the limit in which they will be able to convert the convertible note or the safe note? What is going on there, Adrian? If you can give us a little bit of your knowledge.
First off, the founders and investors need to decide if they have which philosophy they're taking when it comes to a note or not, and at what value, right? It used to be that caps were actually caps, meaning that they were high enough, they would just make sure they would catch a company before it really blew up and rewarded an investor for being in early, right? And they were really, really high, right? And what's happened over time is a lot of those caps have come down to the point that they're not pricing the company, but they're pricing the company, right? They are. If you raise money in a pre-seed or seed-ish stage, and you've got a cap that's like 5 to 7 million, you price the company. That's the price of the company, right? That's the valuation, right?
Yep.
If, however, you say, no, I'm just going to make sure that I'm a seed stage company, but I'm going to have it at 15. Okay, then it's really a cap, right? And by the way, I'm not advocating so one way or the other. I think both are fine. It's just like you got to get on the same page of what you're actually trying to accomplish, both as a founder and as an investor. And so, we run the gamut in our early stage. We don't do many notes, but we'll run the gamut of doing these, on simply just being straight up discount, and the valuation is whatever it is when the seed round comes through, or being like, hey, you know what, okay, you want to do a note, let's do a note because it's cheaper, but let's do a note that has a cap that represents a certain ownership, as I mentioned earlier.
Okay. I guess the methodologies you use for determining this cap are basically the same for
effectively the same as
valuation.
ownership basis
Good.
on that one. But that isn't always the case. Like I said, there's certainly other times where we've had, our sort of mind melding with the founders has said, like, no, this is the right path, is to do a 20 to 25% discount. And, the next price is whatever the next price is. And maybe we go and lead it, and maybe we don't, right? But I think that's sort of the situation, that it's sort of a situational thing, if that makes sense.
Definitely.
And Fernando, you mentioned sort of safe versus convertible note. I think it's some of that's geographic, right? I mean, I think there's a lot more receptivity to a safe, on the West Coast and in certain larger markets. I think in some markets they're just not nearly as accepted, maybe, and I think so. And sometimes they're investors that are unfamiliar with it would just prefer to do kind of what they're more familiar with. I think maybe that's changing. I don't know, Adrian, what are you seeing in Michigan? I mean, I think there's but I think you tend to see convertible notes kind of more or less everywhere because they've been around forever, and clusters of safes.
We see safes pretty often, and we've done safes, we've done notes. I think it's sort of dependent on the company and what they what's most important to them, right? Yeah. But we've done both. Just in the past 12 months, we've done both.
It's interesting. Carta actually just did an analysis of our data, and we saw for the first time this last year that safes outpaced convertible notes overall.
Oh, wow.
A lot of, taking into consideration, a lot of that volume is probably coming from the West Coast.
Sure.
but it's kind of interesting just to kind of look at the data that for the first time it kind of eclipsed that. So you're starting to see more normalcy there. At the same time, I think from an investor standpoint, sometimes the convertible note can be a little bit more attractive.
Terrific. And now let's go to the next round, Adrian, in which you already have one company that it looks like very promising, but they already have investors with a safe note or convertible note with a value with a cap that is pretty low, right?
Okay.
What do you do in those cases? Have you ever passed in any of these investments because of the previous terms used in the previous rounds? Or is there a way to solve it? Do you take that value cap as the current valuation? So I don't know, what's your point on that?
Great question. We have absolutely passed many times on the basis of previous valuations, previous caps, because we felt like, to the previous point earlier, the founders will never be able to own enough for them to be able to be incentivized to continue to stay with the business. So absolutely have passed on companies.
So
but don't always have to, right?
Mm-hmm.
So 100% have said, hey, it's an open. What's good is that it becomes this kind of very open book kind of negotiation with the founder. Like, hey, this is messed up, guys, right? This is a cap table in a pro forma way that we would get behind, but that's going to mean that either we need to talk about adjusting the cap to get it higher so you're not crushed so hard, or establishing a pretty substantial option pool that we then go and push that back over to the founders to make sure that they have the right sort of equity package to go in. Because again, you're in the example you're using, you're talking about a seed round primarily, maybe an A, probably seed, right? And so there has to be, as I think Jeff said, there's got to be longevity to their equity, right? And so is it fixable? Yeah, it's generally fixable. Do you always fix it? Definitely not. Sometimes you just like, hey, it's just not going to work, unfortunately.
Okay, so the advice here for the founders is fight to get a really high valuation cap, especially on the early stage rounds.
I would go back to having the philosophical discussion with their investors.
Yep.
Are you trying to price the company, or are you actually just trying to make sure you have protection?
Exactly.
Right? And so if you're just looking for protection, then maybe you increase the discount. Maybe do a 25% discount. Like industry norm is 20% generally. Maybe you do a 25% discount with a higher cap. And that's the right sort of philosophy to take, as opposed to saying, well, I'm just going to basically cheaply price the company by doing a note at a low cap, right? I think the other thing I'd say is like, be really efficient with your cash. Like what happens more, I'll tell you what happens more often than not is not being efficient with cash. And that's what really crushes, because then you got to do a seed too, right? Or I should say a pre-seed, and then another seed, and then a pre-seed and a seed extension. This stuff, and that's what really begins to compress the common.
Yes, definitely. Rob, we wanted to talk about a very specific topic. As you know, like around 30% of the companies that are in our accelerator are international companies. And I wanted to ask you, what's going on with the valuation of international companies? You see great companies that they have great traction, great teams. The market is like accepting the product or service they are offering, but still the valuations, when you compare it with companies in the US that maybe have not as good traction, or the market is not as good, but they have a higher valuation. Is it because of the demand and supply of the potential investments in this particular case, or is it more of fear of the unknown in the international companies?
Yeah, I think there are a lot of different contributing factors, but I think the supply and demand imbalance is a big one. I think because and this could be true of international markets or markets outside of the sort of the big U.S. markets, so the major international markets. It used to be kind of like if you're not on the coast kind of thing, right? I think some of that's changing a bit, but I do think that there are where there are only a select number of investors, whether that's in an international market or whether it's in sort of the southeast of the U.S. or whatever, then they tend to have a lot more pricing power than you might in a really highly competitive environment like a coastal market. So I'm interested to see. I don't know if Jeff, you've seen some data from Carta, on some international companies, but I know we've got, there are a lot of international companies that are going to come to the States thinking that they can necessarily get a better valuation here, and it doesn't always work out that way, right?
Yeah, I think one of the challenges you get, it kind of depends on where you're raising the money. And, if the investors are in the US and you've got an international company, that there is some international risk there potentially of just not being as familiar with the market or whatever. If you're a international company raising something domestically, you might not have as much of a supply there where, then that can impact you. So I think there's a lot of dynamics kind of that impact this. But, Rob mentioned that it's not just international, but it can even be, domestically here in smaller markets, where if you go to San Francisco, you've got a lot more investors there. And so it's kind of that, where are your investors from, can also play into that.
Yep. And Rob, specifically, you talk about like branches, creating a branch or a subsidiary in the US as an international company. Do you see this as a potential benefit right now, or you would avoid this as an international founder?
I wouldn't necessarily push it or advocate for it unless it's going to serve a much more important purpose, which is an opening and entree into a much larger market, right? So, for example, I worked on a project in Canada a few years ago where they were talking about how important the U.S. market is to the Canadian economy and in the startup kind of ecosystem. And so in those cases, right, it made a lot of sense for Canadian businesses and startups to open a U.S. presence. It can make sense in some cases if you're trying to Stripe Atlas is a good program that's trying to do this a few years ago, where they were helping kind of incorporate international companies in the U.S., provide them with a U.S. bank account, and get them sort of off to the races, so that if they were to raise money in the States, it would just make it easier, right? Because they were incorporated maybe in Delaware and so on and so forth. So you had a lot of the sort of the kind of the infrastructure ready for them. But I don't know that it made the difference. It didn't necessarily mean therefore you're going to receive investment or raise money, but I think it couldn't hurt, right?
Yeah, specifically, I knew of some venture capital firms that were focusing on companies that were already Delaware C Corps. So the idea behind it is that, yes, as an international company, you are not a Delaware C Corp, so maybe it's a good idea to open a subsidiary here in the US because of those reasons. And then you have like you're opening a new possibility of potential investors.
Yeah, I think along those lines, you get, familiarity. So it's kind of what Rob was just saying, is a lot of investors are familiar with Delaware law, right? So you know what you're getting.
Yep.
You may have to do additional due diligence, or you may have even restrictions from your LPs as a fund manager on what you can invest in. And so if you're a Delaware C Corp, it can potentially open it up to more investors potentially.
Mm-hmm. Adrian, I don't know if you have any specific feedback for international companies. What can they do to first boost their valuation, and second, convince venture capitalists and angel investors from the US to invest in international companies? Usually they have like a specific politics in that we'll invest in Midwest companies or in companies in California. Sometimes they're open to internationals, but for these companies, for these VCs that are open to invest in international companies, what would you advise to the founders to reach out to them?
I know that this is a valuation conversation and all, but like the first and most important thing is having it drive with your strategy, right? So if you are going to launch a branch, an operation in the US as an international company, then it should be because of what Rob said, because
You're
it's gonna
attacking
create
the
a new
market.
market for you. But like that is number one. If you are doing it in an effort to like juice a valuation, it's generally not going to work out great. Right?
Definitely.
You know, the number one is create value and add more customers and more revenue. And if you know, creating a new office in or branch in the US makes that happen, that's super, right? That sounds like it's a really good strategic decision to do. And then if that then allows you to get access to more investors, then 100%. So back to that one, like I totally agree with Jeff. There are a lot of investors who will only invest in Delaware C Corps. That their LPAs won't allow them to invest in LLCs. And
the other
won't allow them to invest. So just an example, we can't invest in anything that's not a U.S. or Canadian corporation.
Okay. Yeah, exactly. And the other question, Adrian, is you're a company that is based in the US. What can I do to increase my I'm 100% sure I'm going for an equity round. How can I improve my valuation?
You mean as an international company or?
Correctly. Not and yeah, no. As a US company, how can I improve my valuation? And second, and most important, how can I determine the value of my company in an early stage? Because I will not have the expertise of a VC. I will not have the experts as you at their side. So what can I do?
So I'll answer the last one first. The market generally decides what the price is or what the valuation is, right? You know, the external market says what it is, right? Whether it's a competitive term sheet and you can drive up the valuation because of having a competitive dynamic, which can be great. Now that's out of your control. I mean, it's not completely out of control. You can certainly put together what's called a process, right? And try to get the VCs to compete and come together and give you the best price. But I'd say what's even more in your control is your growth rate, right? How fast are you growing? If there's one thing that drives valuation, FOMO, you know, et cetera, for investors, it's growth rate. How fast are you growing on a month-by-month basis, on a quarter-by-quarter basis, right? And when you start to exceed the 100% annually and you're getting into the 200% and 300% annual growth rates, you begin to get into this kind of world of like, okay, you're really able to be able to kind of get a premium on your valuation given that growth rate.
The premium on the valuation based on that, is it
and remember, it's not again in my world of early stage. It's not like there is some multiplication happening that, you know, hey, I'm going to do 8 times 3 and like there's no that it's from a competitive dynamic. Right. So I'm growing so fast and I'm connecting with a bunch of different VCs and I'm able to put together what's effectively, you know, called a process, which means that I'm going to get a bunch of term sheets in about the same time. Right. Now, look, don't get me wrong. Like I said, you know, you get into the sort of $1 million+ ARR, people will certainly talk about having multiples like 6 to 8 to 10 times multiples in that world of like Series A and beyond. And you can do that, right? And you can get that. And sometimes you get premiums on those based on your growth rate, for sure. I don't want to, you know, take that away at all. But by and large, at the earliest stage, you're getting it from a competitive FOMO.
Sounds good. So the best advice here is get as many potential investors
that's
as
not
possible.
what I'm saying. Again, like I would argue as a founder, the highest valuation is not always the best valuation.
Okay.
Agreed.
Yeah, definitely.
Right?
Definitely.
So you could get yourself a really bad partner that gives you the highest valuation. Or just as importantly, if you go out and you get a really high pre-money on your seed, but then you don't perform because you haven't been as efficient with cash, you're going to be facing a down round or something, you know, more substantial, maybe not out of a job. And then you can't get back to that. So that's why you got to really understand what that future outlook is. What's a sort of normal? This is why Jeff's data is so important. Like, what's the normal seed round look like? What are the kind of ranges of pre's and posts, right? And then what do I look like from a Series A, so that I don't get what we say over our skis.
Yes.
Sometimes you get
Definitely.
over your skis in valuation, and you
And-
don't want to do that. So yes, I mean, certainly competition helps to increase valuation. That is not always the best thing to do for a company.
Yes, definitely. And
Yep.
one more thing there, Adrian, you were talking about down rounds. We know a lot of industries got really hit because of the COVID situation right now. A lot of them, they are doing these down rounds. Is there any recommendation for them specifically?
You know, I think the only thing is you do a down round because that's the only option other than liquidating the company and
Yep.
shutting down. And so I think all you can do is just make sure that you can make it as you know, it's not painless, but have as little pain as possible, and get a point where the company has a really credible pathway to be successful after this very difficult round. They happen, right? It's a way of the world. They happen. And but if you're going to do it in a way that you don't have to do it again if things don't go well. Like, do
Yes.
it, take the pain, and then move forward.
And just to wrap it up, I wanted to ask you personally, any tips you would give to any of the founders in our accelerator, national and international companies alike, to avoid any pitfalls during the valuation process of their companies on early stage seed and Series A? Jeff, maybe we can start with you. You have a lot of experience using the software and also real experience valuation as a founder. What would be your recommendations there on the negotiations when you're like running your different exercises to determine your future cap tables? What would be your advice?
Yeah.
No, it
Well,
goes back
yeah,
to what
go ahead, Jeff. Yeah.
Adrian was saying. So Adrian was saying talking about how a company might focus solely on its valuation. That's not the only thing to consider. You don't always take the highest valuation. In fact, you know, you might take the highest valuation or push really hard for a higher valuation, and the investors might come back with preferences or something that's going to protect their downside. It ultimately comes back to, you know, de-risking the company for the investors. So if the investor can see that, you know, there's less risk in this investment, then they're willing to give it a higher valuation. If they see that the valuation's getting up there, they may build in some protective provisions that, you know, are going to protect their downside, and that might not be in the best interest of you as a founder. And so it's not always just about valuations. I think the other point that Adrian made was look at what's going on out there in the market when you're talking about your valuations. And, you know, you can get data out there, but then what I tell all the founders I work with is make sure you get a really good startup attorney that is in the space, because they know what's going on, and they'll know if you're like, you know, shooting for something that's way out of the ballpark. And the investors will appreciate that as well when they're talking to an attorney on the other side of the deal that knows what they're doing, and it's going to just make the experience better for everybody. And so that's one piece of advice I'd give to every startup founder.
Thanks, Jeff. Adrian, you also have experience in the other side as a startup founder.
Yeah.
I know right now you're working for a VC, but if you were on the other side, what are your don'ts, your do's and don'ts for the fundraising process in terms of valuation?
Yeah. So, I mean, Jeff hit a lot of I think the best ones there. So from a founder perspective, I would say don't. I want to circle back to something that's pretty important, that has an effect on the future kind of wealth generation and opportunity for a founder. Early on, we start companies. We sometimes start companies with kind of a lot of people around, right? And sometimes we don't see the opportunity kind of as what it will be in the future. 3 years down the road, 5 years down the road. And we allocate equity in a way that doesn't take into consideration that kind of the potential of that future state. And we don't know what that future state looks like. And so what I would implore founders to do, and I know I talked about this earlier, but I want to reinforce this point. Set yourself up on vesting immediately, and your co-founders on vesting immediately. And make sure that the allocations at the outset are as representative as they can be on both the current state and what that future state looks like, right? Yep. And make sure those vesting schedules are at least 4 years. And it's gonna be counterintuitive, because I can tell you, like, the first round I ever raised as a founder, I didn't even know what vesting was. Like, I'm like, what is this thing? You're taking my company away from me. I almost walked on the deal because I didn't know what was going on.
Or you
I didn't have a great
term,
lawyer, Jeff. But until I got one, I got rid of the one. I got a new one, which was a great lawyer on the second round through. But I now have such an appreciation for what that is and what it does, because there are many occasions where there is a bunch of what we call dead equity on the table. Dead equity is primarily common, or founder equity, common equity, that is sitting with a founder that's no longer at the company. You see that, and that has an effect, such a cascading effect across the board. You're saying valuation, I'm saying ownership.
Yep.
Remember, that's what's most important, is like, how do I keep as much ownership as possible? The way to do that is to make sure you're not pre-allocating equity to work that has not been rendered yet.
Definitely.
Right? And so that's the thing I would be most focused on as a founder.
Super good. Thanks, Adrian.
Yeah, I'll back that up and just say that you're actually seeing a trend towards even longer vesting schedules for founders. So as Adrian mentioned, it's a little counterintuitive, but as a founder, you want your co-founders invested alongside of you for the long haul. Yep. You don't want them leaving after 3 or 4 years. You want them in it, earning it every step of the way. So Adrian, fantastic point.
Yeah, Jeff mentioned a point earlier about the data. I would just say, really lean in on the data. I think the data, it's not everything, but it's really helpful, and there's a lot more of it now than there used to be, right? So I think, whether it's looking at what are the size of the rounds in my market, how much are investors taking in those rounds, right? Is it clustered around kind of a $3 million raise with a 20% take on the round? Well, then I can back into my, post money, and then of course my pre-money valuation that way. There's just a lot of, and Carta is sitting on a treasure trove of this kind of data. And lawyers are good resources as well. I also think it's important, we haven't touched on it too much, is the option pool, right? I think getting your option pool right in the beginning and making sure you've carved off enough for future hires and talent, and truing up, quite frankly, your folks who are already on board, I think is really important. There's great data around this too. An option pool, is typically sort of 10 to 20% roughly at any given time, with a clustering around 15%. There's no hard and fast rule there, right? That's a very, very important decision that founders are going to make with their board. But having enough set aside to attract talent is important, and quite frankly, also important to would-be investors. They want to see that you've got, enough there.
Definitely. Thank you so much, Rob, Adrian. Yeah, the information you have provided is going to change the life of the founders for sure. I hope that this information for the founders that are viewing this panel, apply it. You now have the knowledge of what's happening in the other side. Don't just listen to this panel and forget all of this for the next mastermind session. I really hope that you apply this to your term sheets and to your cap tables as soon as possible. And hopefully it will allow you to get a better deal from the fundraising process. Again, thank you so much for joining us today. I hope you enjoyed this panel.
Thank you.
All right,
Thank you.